SPR webinar on operational real estate. It's actually the first of two that we're going to have on this subject. This webinar is going to be more operational real estate on a conceptual level, and the second one's going to be more at a practical level. That's probably going to be in a couple of months' time. So for anyone who doesn't know me, my name's Joanna Turner, and I'm the Head of Property Research at Canada Life Asset Management. I'm also on the SPR committee. Today we've got a great lineup of speakers and panelists, as you can see. And so I really, I'd like to thank you all for joining us today. I'm sure we're going to have a very lively discussion and debate. So I'll let you guys introduce yourselves in a minute. Just by way of a quick introduction, at the SPR, we've been thinking about this topic about operational real estate for quite some time now, because I think that real estate has been moving from a fairly static, let's face it, fairly vanilla asset class to a much more dynamic operational one. And with that, that requires a new way of thinking about it. And it also requires a new skill set in order to analyze it and value it. And that has obvious implications for property researchers and investors, as well as occupiers, actually. So the question is, how do we go about understanding and researching it? And what do we need to do as an industry, in the property industry, to make sure that we don't get left behind, and that we fully embrace it, and that we capitalize on, the shift towards more operational real estate. So these are some of the things that we're going to be talking about today. Now, before we get started, I'm just going to remind you of a couple of the admin points, which I'm sure you're all pretty familiar with by now. We have the chat function, obviously, so please do feel free to post any comments and questions on the chat, and I will pose them to our panelists. So we'll attempt to address those as we go along. You're obviously all on mute. You know the protocol by now, but we'll get to answer your questions. There'll also be a recording afterwards, so anyone that wasn't able to participate live can also join that as well. And then I guess finally, we're going to send around a Survey Monkey, so we'd really be grateful if you could fill that in as well, because we really do take your feedback on board on the committee. And we look at all your feedback, and then we attempt to sort of incorporate your suggestions, etc., for future webinars and events, let's say. So without further ado, I'd like to introduce you to our illustrious speakers and panelists here. So I'd like each of you in turn, just very briefly, to talk about what your role is, and what your experience is related to this topic, and kind of what you hope to bring to the table today. So I'd like to start with Bill, if you could introduce yourself, please.
Thanks, Joanna. Afternoon, everyone. So my name is Bill Page. I work in the research team at Legal & General Real Assets. In terms of experience, I recently, with a separate hat, chaired an IPF study into operational real estate. So that was good because I did none of the hard work. I just kind of organised the process. But Didobe, Heriot Watson, and Nottingham University did a piece understanding operational real estate and its risk. So hopefully I can bring some of those observations to today. But as well, with my Legal & General hat on, we've done some investments into operational real estate. So there's some practical observations I can make.
Thank you very much, Bill. I'm sure that you will. Over to my right on the screen. Caleb, would you like to introduce yourself to anyone who by now surely must know you?
Well, thank you. It's good to be here, Joanna. My name is Caleb Parker. I think Joanna was referring to, I host the Workbold podcast, which covers space as a service. But my day job is I'm part of Newflex, which I like to call the Marriott of space as a service. And in the hotel industry, as we all know, when a developer develops a hotel asset, they go out and pick Marriott brand, ask Marriott which brand to put on it, and then they hire a hotel management company. Newflex is the hotel management company, and we happen to have multiple brands, of which I'm the founder of one called Bold.
Thank you. I, for one, I'm a real fan of your podcast, so I would definitely recommend it to anybody if you haven't sort of tuned in yet.
Thank you.
Thanks. So, Matt, would you like to introduce yourself, please?
Yeah, no problem, Joanna. Good afternoon, everyone. So Matt Sofair, I work alongside Bill at Legal & General Real Assets team with a focus on research. My focus is typically consumer-facing sectors, but increasingly leading our research into operational real estate, where, as Bill kind of mentioned, we've got a number of different kind of investments within that sector or within the industry across a number of different sectors. So as part of today, I'll be running through a bit of background into the topic and giving you a few of our kind of practical examples from Legal & General's perspective around our learnings and experience in the sector.
Thank you very much, Matt. Last but very much not least, Ollie.
Joanna. Yes, so Ollie Saunders, I'm the head of commercial valuation at JLL in the UK, but also run our EMEA alternatives valuation business for the business. For the previous 5 years, I ran the UK alternative business, which looked at both capital markets and valuation and how we give advice to clients. And I'm a valuer of 30 years standing, and I suppose one way of putting it is I don't like rent and yield. I've always valued operational real estate and specialist assets. I'm also very passionate about valuation. I've written a textbook for the RICS on it, and I'm sure that will come up as to how we value these assets going forward. And my professional interest is in the self-storage market. So we've been working with L&G, helping them come into that market as well. So I'm often found loitering around in yellow corridors.
Loitering around in yellow corridor. Thank you, Holly. That's fascinating. Right, so I think we're going to make a start. So, Matt, I would like to ask you if you could share your screen, please, so that you can give your presentation. Matt's going to give a presentation which is going to be sort of very much introducing the topic and some of the issues, which hopefully will spark some of the questions in the panel session. So over to you, Matt, please.
Thanks, Joanna. And yeah, just to build on what Joanna said, I guess the idea of this presentation is to give you a relatively high level bit of background into operational real estate, why we think, certainly from a Legal & General perspective, we think it is going to become an increasingly important part of the real estate universe and the investable universe, and really what are the implications for real estate teams, and just, I guess, prompt a few questions, which I'm sure will be part of the panel discussions going forwards around some of the implications for both researchers and broader real estate teams. So if we get cracking and we just kick off with a little bit of context into the operational real estate sector, and I guess it's really important to put it into context of what's going on in the broader property sector. And, you know, the kind of spell, you know, this real evolution, some might say revolution, in terms of how we go about managing, operating and leasing property in the UK and internationally. From our perspective, there's kind of three key elements that are really driving this shift towards property in general becoming more of a operationally intensive asset class. Firstly, on the left-hand side, you know, ultimately those traditional property sectors that we've invested into are becoming more operationally intensive. We'll all be familiar with the downward trend in leases, in lease lengths that we've seen over the past decade, which is pretty well established across all traditional sectors. I think from our perspective, we'd say it's in general been a pretty reactive response in many respects from owners. And it's primarily been a kind of response to occupiers wanting greater flexibility, both in terms of the lease length that they're signing up to, but also the type of space and the service that they're getting as part of that space. And that's certainly been hastened by new innovative operators that have come into this space who are offering more flexible and higher quality offerings than has traditionally been offered by real estate landlords. I think it's important to say it's not just lease lengths. Operational real estate doesn't just incorporate shorter or more flexible leasing. It's also how you go about operating that space and also interacting with the end user of that space. And I think the key thing to stress from our perspective is this is a trend that is not going to reverse. This is here to stay. On the other side of things, we've also already we've mentioned about what's going on within traditional real estate, but also what we've seen over the past, again, decade or so, has been this real growing demand for alternative real estate sectors. That's kind of due to a combination of push factors. So obviously, some of the structural challenges or structural issues that are facing traditional sectors, such as retail and to a lesser extent offices, have kind of encouraged people to look beyond those core sectors into the alternative universe. But also there are a number of pull factors that are kind of drawing people into that universe. And again, one of the key elements around that is, yes, there is some long income in there, but also there's a number of really attractive and interesting emerging sectors with great supply and demand fundamentals, potentially better fundamentals than you might see in traditional real estate sectors. But the reality is, if you want to access these sectors, you can't access these sectors without taking on greater operational exposure and risk. If you want to manage a build to rent offering, then it's not just a case of marketing the building and setting up a lease with one occupier. Clearly, that individual building is comprised of tens or hundreds of individual leases. The other element that is kind of, not just restricted to alternative space, but operational space in general, is this opportunity to really potentially access some higher returns and also income upside by taking on the operational management of the business as well. So a couple of kind of pull factors pulling people towards the operational real estate sector. And then the third element that I think is a really interesting one and a really important one in terms of how, in terms of what is driving this shift to more flexible uses of space. And that is something that I'm sure Caleb will touch on this later on in the panel shows, is around space as a service and this idea of property being on demand. And the fact that actually, if you look at a lot of tech services and apps that have really become integral parts of our lives, we want to be able to access these services on demand whenever we want, wherever we want. And we want to be able to cancel or sign up to that product at the click of a button. So that kind of increased demand from us, I think, as consumers, I think is also filtered through to the demands of space from occupiers of that space. And really that puts the emphasis on the managers of that space to really intensify the use of that space and get, again, far closer to that end user. From our perspective, I guess it's important to say that, when we talk about operational real estate, I think there is a difference and a nuance between operationally intensive real estate, which is kind of more your short or flexible leasing, and really true operational real estate. And we'll touch on this on the following slide here. So what we've got here is just a definition of operational real estate. And that was part of a report that Bill, who's also on the panel, chaired as part of the IPF, which is pulled together by Didobi and the wider team. I think it's a really comprehensive way of defining the operational real estate sector. And what that is, it's a real estate investment where the return is directly and deliberately linked to the revenues and profits of the business conducted on or from the premises. So a real deliberate shift, moving away from the protection that we've traditionally got from a lease, which is obviously defines how much rent should be paid over a set period of time, which is anchored to that initial payment level, to a model where our, as owners, income is directly linked to the revenues and quite often the profit of the business operating from that building. And within that sphere, there's a range of different levels of operational exposure, which is worthwhile being aware of. You've got everything from a hybrid lease, which would typically involve a lease which is based on the rent or the income due to be paid being a percentage of the turnover or the profit from that individual building, with the occupier being more responsible for the operating costs. So you're taking some of the operational exposure, but you have less involvement potentially in some of the operational management of the scheme. If you then move up the kind of operational intensity spectrum that we've got in front of you here, you've got things like management contracts, which involves, getting a third-party operator in to manage the property on the investor's behalf, in which case you're taking on more of the operational risk or all of the operational risk, to the fully integrated model, which would be that owner-operator model, where the owner also operates the building as well. I think a key thing to stress at this point is This is not a model of real estate that is restricted to a particular sector. We certainly see operational real estate as something which is impactful and relevant across all sectors, which is really important for how we go about thinking about researching the sector and researching, I guess, property and putting together portfolios in the future. So I guess, all well and good giving you kind of a bit of theory and a bit of background around the topic, but just to try and bring it to life here, what does operational real estate look like in practice? Here we've just got a couple of examples. These are actually buildings that are owned and managed by Legal & General Real Assets. On the left-hand side, we've got self-storage, where we've got a number of assets that are under management agreements, and we've had we've grown our exposure, I guess, to that part of the market considerably over the past few years. What initially drew us to the sector, and to kind of give you a bit of background about why we've ended up being in this in the operational space in this sector, because you can have leasehold deals within the sector, is ultimately we like the sector in terms of underlying dynamics, the relatively low capex and the fact that it's pretty counter-cyclical compared to a number of other real estate sectors. But actually what we found was we're developing all this expertise in-house. The operators themselves, there's quite a significant potential for further expansion from those operators, and they're looking for real estate partners to help fund that expansion. So there's a number of different kind of pull factors that mean that actually, in order to get exposure to that sector, we really need to be taking on some more operational exposure, and also we can through the process of that start to think about how we can access some stronger yields and stronger pricing within the sector as a result of potentially developing it ourselves. Second sector, which is a bit more familiar probably to many of the people here, is the hotel sector. Again, we've got a couple of hotels under management agreements, including one that we've just recently purchased within Clerkenwell. And again, fundamentally, it's many people would see it as being an attractive area of the market, COVID notwithstanding, but where there's pretty favourable supply-demand dynamics, and there is a bit of a disconnect between pricing for say leased assets versus operational assets. But really, the really interesting thing about these two examples is ultimately how different it is from an underwriting perspective as a transaction team, as a research team, and how different those types of investments are from an operational standpoint, which really kind of taps into a key part of, I guess, this move towards operational real estate, and the fact that really it's a sector that requires a significant amount of expertise. And the fact is, the underlying income stream that you get from a self-storage asset is pretty different in terms of volatility and the type of cost exposures than you would get on the hotel sector. So really, if you look at things from a net operating income margin ratio to total revenue, you're looking at around 35% for a typical hotel to close to 60% for self-storage. So, the risks from an operational cost perspective are quite significantly different for those two sectors. Other types of things that you really need to consider are things like whether it's a stabilized asset or a developing asset, which again, it's pretty integral to how you build up the returns from that investment over time. So I guess, what does that mean ultimately for investors, for people not just in property investment but investing in other asset classes? What does this kind of growth in operational real estate mean? In our view, it's a really exciting opportunity, and the chart here is designed to showcase where property is typically sat as an asset class in relation to fixed income and equities. And really what we're seeing is, as a result of this kind of shift towards more additional operational real estate opportunities, in combination with the fact that you've also got long income on the more secure end of things, you end up with this really quite wide opportunity set for investors into property, and it really starts to give you a good amount of optionality as a fund manager, as owners of property, and a number of different levers that you can pull in order to start to try and meet your investors' investment objectives, depending on what they may be, and certainly gives you an opportunity to meet a potentially broader range of objectives than traditional property could in the past. And more so, we kind of think that this has fundamental implications for how investors should or potentially will go about structuring portfolios in the future. So typically, we've been very much when we talk about constructing portfolios, we often talk in terms of sectors. As we kind of mentioned beforehand, I guess firstly, there's a point around whether actually the typical benchmarks that we use to construct portfolios on a sector basis are actually reflective of the built environment. We'd probably say they aren't. We'd say that MSCI 10 years ago is the left-hand side of this chart, which included about 50% of retail, dominated by offices, with smaller allocations to industrial and alternatives. If you actually look at, the built environment as an entire entity, actually we think there's far bigger scope and far more opportunities within some of those other sectors that have traditionally been slightly neglected. But I think the reality is, we do need to start moving away from thinking purely in terms of in sectors when we're going about constructing our portfolios, and a far bigger emphasis for investors in the space is more about the investment style that you're trying to sign up to as part of, and you're trying to create as part of your portfolio. And rather than just thinking in terms of sectors, you need to be thinking about what's the appropriate allocation to operational real estate versus long income versus traditional. There's a few additional considerations that I've listed around the bottom. I'm not going to go into all of these. I'm sure we'll cover off a couple of these topics as part of the panel discussion. But the one which I'm sure we will talk about in more detail is that point around net zero carbon. And it's just to stress from our perspective, in order to meet some of the net zero commitments that we've certainly made, and I'm sure for the industry as a whole, having greater operational control is a really integral and fundamental part of being able to try and meet those commitments and make those changes that are required to buildings to make them future fit. I guess if we think finally from more of a research perspective, I guess we do think, again, this shift towards more operational real estate does have implications for researchers within the industry, and really kind of makes you have to consider differently what good looks like across these different styles of investment. So are you more preoccupied with the credit rating? Essentially, you don't care as much about the credit rating when actually you're in the operational sector, because actually there you're really trying to understand more around the net operating income and what the risks are around that net operating income going forward. But certainly this kind of shift towards operational real estate does have implications for researchers going forwards. And certainly as an industry and as a kind of community, we need to be pretty open-minded in terms of expanding some of the technical skill sets that we've got within the sector to incorporate learnings from potentially research that is done in different asset classes, but also tying in learnings around the operational side of things, which are obviously integral to successful investments in this space. I think that will be all I'm going to particularly cover off from the research side of things. And yeah, just to wrap up really quickly, and you have to obviously take any questions later on. These are a few summary points that we think kind of sum up, I guess, what the growth in operational real estate means for the sector. And really, the point that I would really stress is that ultimately it's here to stay, and we do fundamentally think that those who don't embrace this shift towards certainly more operationally intensive real estate and operational real estate itself could ultimately be at risk of being left behind. So that's everything from me. I'll pass back to Joanna and stop sharing my screen, and obviously happy to take any questions.
Thank you, Matt. That was really fascinating. There's quite a lot of content in there, so I'm sure there are a lot of points that we could definitely discuss. Just to make a start, we have a question in the chat which I thought we could just quickly address, and then I will sort of start asking you some questions. For anybody else in the audience, please do feel free to post your questions and comments in the chat too, and we'll answer them as we go along. So just very quickly, this question in the chat, I'll just read it out. It's obviously for you, Matt. What's the difference between traditional leased and long income in the real estate world? That was one of your charts in the slides.
Yeah, the way we think about it, I guess they're shades of a similar thing. Ultimately, you're still reliant on, it's still focused around the lease income. I guess the key differentiating factor for us is the percentage of a property's value, which is dictated by that lease income. And clearly you will have shorter leased assets, which really the underlying value of the property might be, it's part in response to the lease, but also part in response to, say, the alternative use of that space or of that building. So for us, that is the kind of differentiating factor. It's ultimately the length of income and the value of the property that is dictated by that lease income.
Okay, thank you. Now, you've mentioned throughout your presentation that operational real estate, this is something that's really growing in importance, and it's going to be much more important in the future, etc. But however, it's obviously been around for a long time. So I'd like to ask you, Matt, why do you think it's therefore taken so long for landlords and investors to embrace it? Is it because it's just seen as too complicated or too risky, too volatile, or why do you think it's taken this long?
Yeah, I think it's a good question, and I think to be completely frank, I think a big chunk of that is kind of the push element of it. So the push away and some of the challenges that are being faced within traditional real estate sectors has encouraged people to look and broaden their scope in terms of looking for investments in different parts of the market, which potentially have better structural underpins than you've necessarily got in traditional sectors. A separate element of that is probably also the fact that you've got disruptors coming into the market who are offering that type of flexibility, which ultimately you've got to, as traditional landlords, the occupiers want, so you've got to adapt in order to offer that type of flexibility to those occupiers. The second element, which I think is, I think that's important, the push element of things, but I think the second element, which is important and worthwhile not, skirting over, is the fact that actually that operational expertise that I mentioned beforehand, it does take time to develop. So really building up that understanding and that skill set within, individual operational sectors within these industries does take time. And I think that is also a contributory factor to the fact that it has taken time for this part of the real estate market to become a bit more mainstream.
Thanks very much, Matt. I'd like to turn to you now, Kayla, because you offer this space as a service sort of concept. So I'd like to ask you just to describe really what space as a service really involves for people who are not that familiar with the term. And for instance, the focus of space as a service very much on the customer, offering a level of service and amenities and etc. that traditionally you haven't got from a traditional landlord, let's say. Now, do you think the pandemic has caused tenant and customers, do you think it's caused them to expect more from their landlord in terms of the service provided, the amenity provided and things like that? Do you think that's what it is? Or how do you think the pandemic has changed customer and tenants' expectations from their landlords?
Well, so it's a loaded question, and I think it's not a short answer, but first I'll refer back to Matt's presentation. I think the decreasing lease terms is a trend that's going to continue. Companies are looking for buildings that offer flexibility and service. I think what we've learned over the last year is we don't need an office to work. Many of us have worked through multiple lockdowns over the last 12 to however many months. So what's going to make us wake up every morning, get up earlier and commute into the office? Why? We need these environments that are as flexible as we are, and better environments than working from home. So I think that sort of has been a wake-up call for everybody. It used to be you had to go to the office because that's where our computers were, but obviously broadband and modern technology, we can do that anywhere. And we've learned over the last year that's ubiquitous now. Everybody can do it. It's some people were doing it, some companies were doing it for years leading up to the pandemic, and so they didn't skip a beat in March 2020. But now nearly every day we're seeing announcements from companies like Google and Salesforce and so many others that are leaning into hybrid working. The challenge here is that most companies don't have the budgets of Google and Salesforce. You know, Google might be able to take a white box and turn it into this dynamic hub with high quality amenities and fully connected for hybrid working and bookable on demand when people need it. But not every company can do that. So they lean back to the landlords, back to the assets to help provide that, because while most companies aren't Google, they're still competing with Google for talent. And so to me, that's where the opportunity is for office buildings, to help companies attract talent by offering all these services that make coming into the office better than working from home. So I think for me, it's a wake-up call. It's like the perfect time for us to think about repurposing assets for space as a service. If you look at what the MSCI came out with recently, 60% of office rental income is tied to leases that either expire or have some sort of break clause in the next 5 years. So I expect there'll be a lot of right sizing happening over the next few years, some distress on the market soon, which to me is a signal. It's a perfect time to start thinking about providing new ways of working and making sure these assets are ready for this new demand. And then I'll just finally say that I think the biggest shift that needs to happen in our industry is commercial real estate needs to shift from a B2B to a B2C mindset, which means that, you know, historically it's all been about, you know, the money, making sure the numbers work out, and that doesn't go away. But we have to put the customer in focus, the end user of the building, because that's going to ultimately we need drive what we do with that asset. So if we first decide who we want that customer to be, what is their persona, what experience do they need, and then we go out and deploy B2C marketing and customer acquisition campaigns that actually sell the benefits of choosing to work in this particular building, not square foot, not lease terms. We're not selling square feet anymore. We're selling superpowers to people. We're selling environments that help them work better than working from home. And so finally, just providing that great customer service every single day consistently, so those customers feel great when they choose to come work in our building.
Sounds brilliant. I wish I could work in one of your buildings. So I'm going to ask you now, straight to it. Key question then, Caleb. So do you think the growth of operational real estate has been a revolution, or it's a natural evolution then of the market?
Well, I think before March 2020, I get a short answer for you on this one. Before March 2020, it was a slow evolution. You know, as Matt was saying, we've seen this grow over time, but over the last year, I think we're at a revolution now. It's been a wake-up call for everyone, as I've already said. So I think we're at revolution stage. Okay.
Does anybody disagree with Caleb there, or has anyone got a different opinion to that? Revolution or evolution?
I think it's more of a sort of an acceleration of the evolution through COVID. We knew this was going to happen anyway, and actually we said where we are today in May 2021, we thought we might be in May 2025. So it's just compressed the timescale, I suppose, that's made that happen. So there's been nothing so shocking for us in real estate that's happened. It's just happening a lot quicker as well. So I think people have really woken up to it.
And if I can expand on that, I think a lot of what Caleb described was also around operational intensity as well as operational exposures in real estate. And in a sense, that's been helpful. So for a while, we've recognized that offices in particular needed to work harder to manage their occupiers and manage the employees who work for those occupiers. And as Ollie said, the pandemic has accelerated those requirements. In a way, it's helpful for a more institutional landlord that they've got used to greater operational intensity, because the gap to operational real estate and income is therefore a little shorter. It's still a big gap, and it's still a bit of a leap for many landlords. But because people are having to get used to working their assets harder, being better managers, being better operators, regardless of the lease structure, that change to the lease structure becomes a little easier to absorb.
Thank you, Bill. I'm going to stick with you, if I may, because you were obviously heavily involved in this IPF research study on operational real estate. Now, bearing in mind that this type of real estate, it's more flexible, it's potentially more volatile, it's more complex than traditional real estate. So how can you give us just a few of your key insights? I know it's like a massive study, but how that impacts on pricing, and how investors look at it in terms of do they require an additional risk premium, for instance, for this type of concept compared to traditional real estate? So how does it affect sort of pricing and risk and things like this? I know it's really complex, but just a couple of little insights if we could.
I'll do my best to answer that briefly. As you said, there's a lot in the IPF research report about that, and a lot of good theory as well, which I won't try and replicate today. But that issue of risk is fundamental, of course. Although I think also there's a mindset required here. Yes, operational real estate, as you're deliberately linking your performance to a business, is different than a flat lease structure. But if your alternative is void, for instance, which is a big feature of retail, is that any more risky? And if it's going to come to many of these sectors anyway, are you taking on more risk? So we've had turnover leases in retail for a long time. That's a form of operational real estate, in my view. What Caleb described in offices has been coming for a while, and increasingly landlords are deciding actually they would prefer to get some of that upside from a well-run space without giving that upside to WeWork or Regus or someone else, for instance. So that issue of risk can be debated, but in a theoretical sense, what the IPF research does, and Didobi did well, is explain, there's various different ways that investors can calculate performance, return, and risk. We all know in practice, there's no set standard. People do it in different ways. The research suggested net present value as a simple and most robust way of doing it, with a big emphasis on the discount rate, so the risk premium you calculate to make that model work. Within that risk premium, it is different from traditional property underwriting. In some instances, most of that is because of the business risk you factor in because of that level of exposure. So the IPF study and Didobi make some suggestions for that, and there's a very good waterfall chart in terms of how to build up a risk premium. And if you're anything like me, everyone enjoys a waterfall chart because they're nice and clear. But they use an example of a hotel. And of a risk premium of about 6%, about half of that was the business risk premium. And that's just by way of an example, and people can try these things out themselves, but that shows a notable difference from a traditional property underwrite.
Thank you, Bill. Ollie, I'm going to turn to you now. Related to the whole issue of pricing is about valuations. So it's an enormous topic, and I know that Caleb has a particular interest in this topic as well. It's about how you value, and I know within it there is lots of different models, etc., and structures. But I'm going to just put it to you. Do you think that the RICS Red Book is kind of out of date when it comes to valuing these types of assets compared to traditional assets, given the complexity of the income streams, the revenue, the service levels, etc.? And can you just give us some thoughts on where the valuation industry, your own industry, is on that and how it's evolving?
Yeah, well, it's a very hot topic for the valuation profession, because there is currently an independent review being carried out by Peter Pereira-Gray of Wellcome Trust into how valuers have done and our relationships with our clients and how we give advice. And one of his questions was, should the RICS be prescriptive on how valuers carry out valuations? And I think he is going to conclude, he's asked for evidence, but I think the conclusion is that they should not be prescriptive, because actually that would stifle the innovation. And a valuer's role, of course, is to replicate how the market is actually pricing by being immersed in that market. Now, I'm a big fan of moving everything towards discounted cash flows in that much more explicit nature of valuation. for valuers to have a good understanding of the cost of capital. So back to Bill's points and the different techniques. So valuers do need to think about weighted average cost of capital and what debt markets are doing and how that goes to pricing. But also very much of relevance to your members, it's the data that we have available. So actually in reducing that risk, if we've got more certainty in our cash flows and our understanding, that makes it more investor friendly and so on. But I suppose also it's really important that the valuer knows what they're doing. So if you're valuing a car park, you really need to understand what is delivering those returns in that car park industry and what the benchmarks are, and what reasonable efficient operators are doing. And that is made better if we have more transparency in the market and more data available to us. So it's a slightly self-fulfilling prophecy. The more information that's out there, the more we understand the risk, the more investors will come in, particularly the institutional capital that may be more risk averse than some of the more venture capitalist private equity ones as well. And also, as a valuer, you need to look at it from lots of different approaches. So, when we're looking at flex space, we'll look at sale and leaseback structures, we'll look at cash flow approaches, we'll do standbacks and looks, and we have to replicate how bidders in the marketplace are actually pricing it. Otherwise, a valuer is just doing a calculation of worth of what Ollie Saunders would pay for it, aren't they?
Thank you. I actually think it's a fascinating topic. And if you don't mind, Caleb, I'd like to bring you in. Can you give us some of your thoughts? I mean, you've dedicated a whole podcast to the subject of valuation of space as a service and how it needs to change, etc., haven't you? So you give us a couple of your key insights on valuation.
Well, look, I would say that I'm not the expert in the area, and I've been glad to share other people's expert opinion and insights. But I think my biggest gripe over the last year or couple years has been that there hasn't been an update to the valuation methodology. And if we go back to the presentation earlier, we saw the self-storage and the hotel industry. There's clear valuation methodologies there, and why can't we borrow those methodologies and bring them onto space as a service, onto the new way that assets should be valued? And certainly historically, space as a service has been limited to a footprint within an asset. It's not been the entire asset. So can we separate those two, have independent valuations, and then combine them is a question. Recently, and I've just tweeted this today, but recently there was a video that was put out, it's on YouTube, on how to rethink real estate valuations and bringing in space as a service. And it accounts for the increased NOI that space as a service can deliver to an asset. So, I'm going to speak at a high level here because I'm not the expert, but I just think that we need to be looking at the hotel industry as an example.
And actually, to go back to what Bill said, I mean, I absolutely agree that retail is becoming operational real estate. So it's more than turnover rents, isn't it? And actually how people price that and understand the risk. And it's very, and I think the valuation community is coming under huge criticism, where you go to two valuation houses and you get some quite broadly different answers. And actually that's not a good thing, as we're in a sort of pricing discovery. But so, our commercial valuation team is spending a lot of time talking to our hotel team, because they've been valuing operational real estate for 20 years and what benchmarks they've got. They've got incredible databases about how hotels are performing in Reading, and we need to understand how retailers are performing and understand those turnovers. So it's a fascinating time in the valuation profession. But to Caleb's point, yes, absolutely, that best practice is being applied across all commercial real estate assets, and it has to be, to give the right advice.
So I just want to add in here, and this is, Joanna, you knew this was going to be a hot topic here, but I think that the valuer community should take a stance on this. Maybe not prescribe, but at least, like you say, Ollie, best practice. Because I was having a chat with a valuer friend of mine just a few weeks ago, and he was telling me that he's waiting to see how the investors trade. And I'm like, well, the investors are waiting to see how are you going to value it? So it's like this chicken and the egg. So someone's got to make a chess move here, in my opinion. Yeah,
but often the value has to sit in the room with the investors, guiding them on how to price. Absolutely. So you can't be, the valuation profession cannot be a rear view mirror job. You can't look back. You have to be in the market on the 19th of May, thinking about how people are sitting in rooms and pricing things. So that's why valuers have to be close to cap markets, but obviously respecting independence. So a number of valuers need to up their game.
And you say that as a value.
Yeah, and JLL is open for business. We'd love to talk to people. Yeah, but we do need a fresh approach. I absolutely agree.
Yeah. Also, just moving to a slightly different topic now. Do you think, I mean, Ollie, I'll sort of perhaps ask you as well. I know, Bill, you've commented on this as well, but how does the whole net zero carbon agenda tie in with operational real estate? Because what I'm thinking is, with greater availability of data, transparency, we can use energy data, etc. So does this imply, with more operational real estate and better data, etc., transparency, that we're going to see a push towards greener buildings because we're just now more transparent about it and able to see data on sustainability, energy usage, etc.?
Yeah, I think ESG is probably an even hotter topic than valuation at the moment. And
yes, absolutely.
What's fascinating is we've done some research about how offices lease faster, have lower void periods, and at higher rents in central London if they've got BREEAM excellent standards. When you then look at operational real estate, actually a green building, the owner and operator, or the owner of that asset, gets the benefit of the lower costs of use because it's more energy efficient. So for every pound of utility that you save on running costs, you create roughly £20 worth of value. So it makes it even more of a financially compelling situation than something like an office, where often the occupier would take the benefit of those more efficient energy costs. And also some of the design functions that you can have on operational real estate. I'm talking to a student housing developer where all their hot water pipes are in the centre of the building, so they've got the smallest distance possible for the bathrooms. So there's some very clever technology, simple things like that, that makes that deliverable. And of course, green finance and operational real estate is here, so it's cheaper debt if you've got a net zero carbon building. That all goes back to a lower weighted average cost of capital, which creates value, which makes it both ethically, socially, and financially the right thing to be doing. Also on operational real estate, would somebody choose a build-to-rent unit that had high sustainability criteria over one that didn't? So will the customers start walking with their feet to green landlords? So you'll get a green premium and definitely a brown discount as well. So yeah, I think on all facets it's a very exciting way, but the market's figuring out how to price it, how to deal with it as well. We've done a paper on net zero carbon and self-storage, which was published on Tuesday as well, so that's on our website as well, but that's hopefully starting the discussion.
Thank you. Could you just explain why self-storage in particular is a sector that's that you've highlighted to tackle net zero carbon, for instance?
Well, we're working through lots of different asset classes.
Yeah.
Self-storage is actually something where we think the construction and the use of it can get to net zero carbon first, principally because it's quite a low energy user of energy. Hotels are obviously much higher energy uses, so we think that sector can probably do it very well and very quickly. And also quite a lot of it's being built at the moment. There are a lot of very good entrepreneurial developers who want to think about this as well.
Sorry, unmute myself. Matt and Bill, as researchers, Matt in particular, you've talked about this in your presentation about the implications for researchers. Given, the complexity of operational real estate and the fact that it really requires specialist knowledge, do you think that researchers in general, we have the right skill sets, or it requires other skill sets, for instance, from the capital markets, etc., that we either need to acquire or we need to hire from, etc.? So what are your thoughts on that?
Yeah, I mean, I think a key thing is it's an incredibly diverse area of the market, and I don't think it's realistic to necessarily expect an individual researcher to have all the skills that are necessarily required. I think it really comes down to the blend of skills that you've got within a team, which is really important. And I think being able to bring together skill sets that take into account, I guess, an operator's viewpoint, traditional property skill sets, but also, as you kind of mentioned, some of those skill sets that might come in from different asset classes, etc., and can be tapped into. I think that's how you can start to build up a broader skill set for a team that allows you to, I guess, better manage this kind of transition towards this model.
If I can add to that, and I don't think there's a massive leap required from a typical research team. These are skills about understanding markets, understanding accounts, understanding the nature of risk. In a purist term, you could say, okay, we need accountancy skills, we need a credit analyst, we need someone who understands equity markets. But realistically, those skills can be acquired by researchers if they're not there already. They just need to be reapplied. So hopefully, it's training more than rehiring. What is potentially interesting though is whether it favours different types of companies. So we talked about institutional involvement in operational real estate and whether we are too risk averse. Firstly, I don't think we are. Point one is because it's inevitable anyway, and point two, it's a useful balance and income diversifier against long income and traditional leases. But also you could argue that in a institution, there is a credit team, there is an equities team who you could call up and say, what do you think about Big Yellow or share price and things like that. So there is an advantage there, which might favour the bigger institutions alongside perhaps some more niche sector specialist investors. And this doesn't necessarily create a liquidity challenge, because I think these skills are immediately learnable and applicable. But at the moment, it could kind of bifurcate the market in terms of who is out there buying, whether it's the specialists or the bigger institutions who feel more comfortable about the skill sets at the moment.
Thank you, Bill. And what about data? This all implies that we can't just rely on traditional real estate data. Ollie, this obviously affects you too in the valuation industry as well. Should we be trying to use alternative data sets, etc., or or what should we be doing, or should we be trying to sort of collect that type of data from the occupier? What are the implications in terms of data and also how we use the data?
I think both investors and valuers, what's crucial is to understand the underlying business and to understand the sector that occupies that. So in my example of car parks, you really need to understand how the car park operators are doing. And I suppose it's really moving away from rent to EBITDA, isn't it? So you need to look at each of the constituent parts and how much does it cost to turn the lights on in Energy's hotel, or how much rent do they get from their self-storage unit, and what a reasonably efficient operator should be able to achieve. So there's more data, but it is out there if you need to look for it. And also, it's still property, isn't it? It's still about demand and supply, in the same way that a regional office market, that's what we look at. Well, we do that in car parks or hotels or self-storage or data centers, don't we? It's still the basics of real estate economics is demand and supply, isn't it?
Yeah, has anyone else got anything else to add on that in terms of data? Caleb, do you have anything in terms of sort of from your perspective, what you would like to see in terms of improvement of data availability and how it's shared, etc.?
Well, I think in general, we need what the hotel industry has with STR, Smith Travel Research, that was recently acquired by CoStar. We need the equivalent in the space as a service world. It should be anonymized, but give the value of the researcher, the operator who's looking at a market or an asset to understand what the demand looks like in an area. They understand what the competitor set looks like. But diving in deeper to the blended revenue streams that are coming in from that space as a service, because historically, when you think about the various amenities that might be in a building on a lease, a gym, a cafe, a restaurant, some sort of F&B or laundry facilities, all that's on a lease. It's predictable, it's long-term, and that's sort of an easy way to value that asset. But when it becomes wrapped into a service layer on a turnover lease or management agreement, it's a little bit more variable, but it has a higher upside, but I think having transparency across the operators is key there.
I'd probably just support what Caleb has said there. I think it's a real benefit of operational real estate in general is the fact that you typically can get more transparent insight into the underlying cash flow of that operator. And if you look at a sector like retail, it's I think it's probably something which has held back that sector. The fact that, to all intents and purposes, there is a difficulty in understanding what that space is worth for an operator. So one of the key benefits of a more operational model in the retail sector is the fact that you can really understand whether a rent is sustainable or whether it's appropriately priced. So I think that transparency element is a real benefit actually, but certainly there's more that can be done to provide that kind of broader industry insight for individual parts of the market.
I think also the operators who are trying to build these portfolios realise they have to give information to the institutions. So in healthcare in Europe, we're beginning to see leases which require the tenant to provide P&L information to their landlord, and if their rent cover isn't sufficient, there are step-in rights as well. So that would have been unheard of 5 years ago, but that's beginning to come through. So, if operators want to build this platform and they want L&G's capital, well, they do have to give them a bit more information, don't they? So it's a self-fulfilling prophecy as well. So, but the future is all about big data across all asset classes, isn't it?
And I'll just add to that just one last final point, because what's a panel about real estate without mentioning WeWork? I think the issue that came up with WeWork could have been prescribed a long time ago if there was more transparency around their numbers, and we would have predicted this would happen. But by having transparency with the operator, we can avoid scenarios like that again.
Yeah.
Great, thank you. We've only got a couple of minutes left now, so I'd just like to invite all of you just for some final thoughts, just to wrap up really, or anything that you think might help property researchers sort of understand operational real estate better. I'm going to start, I'm going to pick each of you in turn, just 1 or 2 sentences perhaps. I know that is extremely difficult. Matt, can I start with you? Just final closing thoughts.
Yeah, I think the point around, broadening skill sets is a really important one. And the other point, which actually, again, Caleb mentioned, the point that this forces, this shift in how you manage space forces you to think more deeply about that end user. I think that is kind of integral to this part of the industry. And it's a real key focus point, I think, certainly for us at L&G. And I think it needs to be a key focus point for everyone looking to invest and manage in this space.
Yes, thank you, Matt. I think that is honestly really, really crucial, understanding your end user. Perfect. And on that note, Caleb.
I guess my closing point is that brand is going to matter more in commercial real estate than it ever has before when we move into operational real estate, because brand is a specific experience that delivers for a specific customer persona, that delivers a specific economics for the asset. And so when picking what experience and what brand to go on an asset, that's going to matter.
Thanks a lot. Brand matters. Thank you. Ollie, some final thoughts?
I think 2 things. Firstly, operational real estate is definitely on the more interesting side of the real estate market. So there's a lot of change going on. It's about the way we use our cities and the change that we're going through, but also about for the audience, it's about the know your onions. It's about specialist, deep knowledge, really immersing yourself in certain areas of the real estate, and then it's a great place to be. But there's always going to be a lot of work for your members.
Thank you. There's so much material to go on. I'm sure that's going to keep us occupied for years to come, isn't it? Finally, Bill, some final thoughts from you, please.
Thank you. So I think a couple of messages we've had loud and clear here are this is coming. This is going to increase whether we like it or not. I think this panel do like it, so that's good. Yeah. Also, that it's not just the preserve of alternative real estate. It's going to be offices. It's going to be retail, perhaps less industrial, but there things to be done there as well, particularly in the consolidation centres. But I think the message for researchers is, even if it's not a part of your company's business at the moment, it will be. So get comfortable with the concepts, have a go at modelling the different parameters of risk now, and then when it does become part of your business, you'll be better placed to start analysing it properly.
Thank you. That's a great final wrap-up point. So now I'd just like to take the opportunity to thank you all. It's gone pretty quickly. So thanks to all our speakers and panelists. And also thanks very much to our audience there for sort of tuning in. If you have any feedback, please do feed that back to myself or Rita. As I said to you, we are planning a further webinar on operational real estate. So if you've got any suggestions for us, for speakers, panelists or content, please get in touch, and we'll be more than happy to sort of incorporate that. So thanks for joining us today, and I hope you all have a great afternoon. Bye, everybody.
Thank you, Joanna.